Okay, so let's move straight to requirement number B. In the B requirements, you are to estimate the impact of EPPLC's equity holders if premium paid is increased to 50% from 30%. You remember the scenario in the question, especially in the last paragraph. In this paragraph, there is uh, there is an argument between the management of EP and the shareholders of BO. The management of EP PLC has capacity to pay 30% premium, but the shareholders of BO is requesting for 50% premium. So in the B requirement, examiner is now asking you to estimate the impact of EPPLC equity holders if premium paid is increased to 50% from 30%, meaning that if you go beyond your capacity, the extra you are paying will result to loss to you because you are going above your capacity. So what that simply means is that the extra 20% that the management of EPPSC will pay as a premium to the shareholders of BHO will represent as a loss. Therefore, examiner is now asking you to determine the impacts on the shareholders of EP. So in this case, you have already, in the A part of the question, you have already established the impacts, the premium loss, which is 480 million. Okay, that 480 million is the impact on the shareholders. However, you need to determine the loss per share. Whenever examiner is asking and the shareholders are mentioned, so whatever you want to calculate should be calculated to the lowest value. That is, if, for example, I'm a shareholder and I own about, say, for example, 10,000 shares in EP, I need to know if the company eventually pay the premium of 480 million, okay, how much am I losing as a result of that? Because this premium will come out from the company's pocket. Therefore, I want to know how much am I losing as a shareholder. Therefore, you need to determine the loss per share. So without wasting more time, I will stop sharing this and I will move to the uh, working notes. So that will be on the same page, working notes. Okay. So number B, requirements. Number B, requirements. Impacts of additional premium of 20%. Okay. So at this point, you can decide to rewrite the premium. So I will say additional premium. So the shareholders of BHO is asking for 50%, but you have capacity to pay only 30%. 30% of the value of BO. And you know the value of BO is 2 million, is 2.4 billion naira. Therefore, this is what the examiner is now asking you. And we got 480. That is 20% of 2.4. That's 480 million. That's the impact. Total impact is 480. We have calculated this before. Okay. So we have done this before. Now we need to calculate value per share. I will then see loss per share. This 480 million is what the company will lose. It's what EP will lose because it's an additional premium that the management of EP is paying to BO as a result of the acquisition. So if that is the case, I need to determine loss per share. Loss per share. To do this, the loss per share, before I can advise the impact. So I was trying to, before the break in transmission, I was trying to explain that when you have, we are asked to determine the impact of the increase in premium from 50% to, from 30% to 20% to 30% on the shareholders of EPPLC. So for you to be able to do that, after you have calculated the additional premiums paid, which is 480 million naira, so you need to determine the loss per share. That is the additional premium EP will pay per share. So to do that, the total additional premium divided by the post-acquisition number of shares. So we give it the loss per shares. However, this post-acquisition number of shares, we don't have it. Therefore, you need to go and do your working for that. Let me give a small space. Therefore, I would then say post-acquisition number of shares. How do I get that? To get the post-acquisition number of shares, I will have to take the number of shares of EP. Number of shares of EP. According to the question, when you go back to the material, in the question, we are told that the number of shares in million for EP is 210. So EP has 210 million shares. So here will be 210 million shares plus number of shares acquired in PO. Number of shares acquired in BO. So out of 200 million shares in BO, we are told that according to the last paragraph of the question, we are told that EP has offered to acquire BOPSC through a mixed offer of one of its shares for 2 BOPLC shares plus a cash payment, meaning that 50%, EP will acquire 50% of BO's of BOPLC. So what that simply means is that you just take 50% of 200 million shares. So here will be 50%, half. Or simply say 1/2. 50% multiplied by 200 million shares, which is equal to 100 million shares. Therefore, the post-acquisition number of shares, post-acquisition number of shares will then be equal to number of shares of PO of EP, which is 210, plus the percentage acquired in BO, which is 50%, that's 100 million shares. So that gives us a 310 million shares. So the post-acquisition number of shares is 310 million. Therefore, for me to now get the loss per share, I would then say 480 million naira divided by post-acquisition number of shares, which is 310 million shares. So that will give me the loss per share. So bring out your calculator. 480 divided by 310 equal 1.55. That's 1 naira 55 kobo. So I can then say the impacts, I would then say the shareholders of EP PLC will lose 480 million naira or 1 naira 55 kobo per share premium of 50% is paid instead of 30%. That's the impact. So let me rewrite this one. Post acquisition number of shares. Clean this one to give space. All right then. So this is what the examiner is asking in the B part. Then in the C part of the question, you have to estimate the additional funds. You have to estimate the additional funds required if a premium of 50% is paid instead of 30%, and discuss how this premium could be financed. So in this case, you've already determined the additional funds required, which is 480. The additional funds required is 480. However, examiner also wants you to discuss how the premium will be financed. So if that is the case, in the number C part of the question, number C1, we are to determine additional funds required. So I would then say additional funds required. Okay, so just a repetition, a repeat of what you have done previously. So I will say premium of 50%, which is 2 million, 2 billion, 2.4 billion multiplied by 50%. Just rewrite it. Figures in million. Here is, bring out your calculator, 24 multiplied by 0.5, that's 12. Here is 1.2 billion. Then premium of 30%. This is what EP has capacity to pay. 30%. Here is 720. Therefore, the difference is additional funds required, which is 480. The A is additional funds. The fact that you have done the calculation in B does not mean that you cannot rewrite it, so that it doesn't look as if you are just repeating what you have done previously. So just find a way of rewriting it, just like we have done. So number C2, hi. Examiner is asking you also how the premium could be financed. I would then say the premium could be financed as follows. Majorly, as far as M&L is concerned, there are three common ways of financing acquisition. One is through share exchange. One, share exchange. When you finance through share exchange, this represents the most, okay, because of time, it's not enough for you to just list the method of financing the acquisition. You need to comment on each method of financing. Possibly their limitation. So when you finance through share exchange, it may result to dilution of any per share and shareholders proportionate or proportional holdings. What do I mean by that? Okay, let me just write it out first. This represents the most expensive method of financing acquisition or business combination. Business combination. Because it may result to dilution of any per share and reduce or impair the shareholders' proportional holdings. Proportional holdings. Now, what do I mean by dilution of any per share? You know, your profit after tax is the same thing as your earnings. Therefore, if you issue additional shares, your profit after tax will remain constant. It will not change because you are not paying cash. However, the share base, the denominator has increased as a result of issuing additional shares for the purpose of this acquisition. Therefore, the shareholders' proportionate holdings will reduce. Not only that, the earning per share will also reduce as a result of that. So number two method of financing the acquisition is through cash payments. Now, when you finance through cash payments, ordinarily, this does not really have much issue with the company. However, this may result to um, dilution of any per share as well, because your PAT will reduce. Of course, your number of shares remain constant, but your PAT, your profit after tax will reduce because you are paying cash from your PAT. So as a result of that, the earning per shares will be impaired. Okay? This may not involve, this may not involve paying extra costs. Okay? Paying incidental costs. Okay? However, cash payments may result in dilution of any per share. So that's that. The reason why it is diluting the any per share is because of the fact that your profit after tax will reduce. The profit after tax will reduce, but your share base is constant. So as a result of that, the earning per share will surely reduce. Then number three, you can also finance the premium through debt. Okay. When you finance through debts, based on our previous classes, especially under cost of capital, we said that debt is a cheaper source of financing because of tax deductibility benefit. Let's put that down. This is a cheaper method of financing the premium because of tax deductibility benefits. However, debt may resort to dilution of ownership and control. Debt may increase the gearing level of EPPLC and results in dilution of ownership. Okay, so that's that. I think we're okay with this. These are the three ways you can finance, or you can also have a combination of any of the methods. However, these are the three key ways of financing business combination. So let me know if you have any question for me before we move to the next illustration. So far, any question for me?
Yes, sir. So I have a question.
Talk to me.
Sir, please, I didn't really understand the calculation from this B that we started because you did something like total premium loss. Like, how did we come about premium loss and all of these other ones?
It's very simple. Number B, examiner is asking you to determine the impacts of the additional premium on the shareholders of EP. You can see from the question there is an argument between the shareholders of BO and the management of EP. The shareholders of BO is requesting for 50% premium of the value of BO. The value of BO is 2.4 billion. That's what we calculated. However, the management of EP is saying that they have capacity to pay only 30% of the premium. Therefore, examiner is now asking you, if a premium of 50% is paid instead of 30%, what will be the impact on the shareholders of EP? The impact will be the extra 20% that you are paying. So, and that's why we calculated 50% minus 20. The extra of 20% is the premium, is additional premium you are paying because you only have capacity to pay only 30. So that extra 20% you are paying is like a loss to you because it's an extra money you are going to pay out of your pocket as a EP. Therefore, the additional premium loss is 480 million naira. And I'll say that you can't just stop at 480 million naira because examiner is asking you the impact on the shareholder. Therefore, you need to calculate value per share. The loss per share needs to be determined so that each shareholder will be able to know how much should be attributable to them. Okay, the shareholders will need to know how much will be attributable to them in terms of the loss. And that's why we said, okay, in determining the loss per share, the premium loss per share, then you need to determine the post-acquisition number of shares. That is, to get the loss per shares, the total premium loss of 480 million naira divided by the post-acquisition number of shares. So for you to get your post-acquisition number of shares, you need to determine what is the number of shares of EP. Then how many number of shares is EP acquiring in BO? According to the question, we are told that EP will acquire half of BO shares, and BO share is 200 million shares. Therefore, 50% of BO shares, that's 100 million shares. So, and then EP EP has 210 shares. Therefore, 210 shares plus 100 million shares acquired in BO, that's 310. So for you to get your loss per share, 480 million divided by 310. So that will give you 1.55 naira, which means that every shareholders of EP will lose 1.55 naira per share as a result of paying additional premium. Okay? So that is for the B part. Are you clear now, Prosper? Prosper?
Sir, I'm not.
You are not. So what is the issue?
So I'm trying to understand how we, because in the question, the one we started previously, from where we started solving the question, right? This 24, which is the number of chairs, we've been using the 24. We never used half of 50% of it. But now you are saying that acquired only 50% of the company's shares.
Look
So
at the scenario. I've told you already, Prosper, look at the scenario. Even when I was reading, I circled the go to the last paragraph. The last paragraph in the question, you see the information there. You are told that EPPSC has offered to acquire BOPSC through a mixed offer of one of its shares for two BOPSC shares plus a cash payment, such that a 30% premium is paid for the acquisition. Shareholders of BOPSC feel that a 50% premium will be more acceptable. EP has sufficient cash reserve if the premium is 30%, but not if it is 50%. Have you seen that information in your material with you? Hello, Prosper.
yes, I've seen, sir.
You see, every information is there in the question. So EP is acquiring half of, that is 50% of shares in BO. That's where we're, so if the total value of BO is 2.4 billion, remember we did the calculation last time. Let me show you. This is the
Yes, sir. Yes,
calculation,
I still have that.
the value of BO that we calculate. This is the value of BO that we calculated, 2.4. So that is the worth of BO. So you are now told that if 30% premium, the management of EP has capacity to pay 30% premium, means over the value of this company. The value of this company is 2.4. So when you are paying a premium of 30%, so that should be 30% of 2.4. However, the shareholders of BO is requesting for 50%. That means you are paying extra. That extra you are going to pay is a loss to the management of the EP. And that's what examiner is saying, you should determine the impact on the shareholders of EP. And that's how we got the 480 million. So for us to get the value per share, then you need to determine what is the post-acquisition number of shares. And the post-acquisition number of shares represent the number of shares of EP plus the number of shares acquired in BO. And that's what gave us the 310 shares. So when we got 1.55 naira loss per share. Is it clear now?
Yes, I see, sir. Thank you, sir.
You are welcome. So let's move to another illustration. I will stop sharing this. Okay. The question we just solved is scenario 1. Let's go for a question that asks for scenario 2. We said in scenario 2, business risk will remain constant, but financial risk will change as a result of business combination. So when this happens, the adjusted present value method should be used to appraise the business combination to determine the value of the business, of the combined business. Therefore, let's look for a question that has to do with that. All right. Yes, let's go to illustration number 4. Go to illustration number 4, the directors of Arsenal PLC. Please, who will read for us? Let me just read. Let me read. The directors of Arsenal PLC are considering the acquisition of Lacazette Limited, an unquoted company. The shareholders of Lacazette Limited are willing to sell the business on 1st January 2011 for 500 million naira. This 500 million naira represents the purchase consideration. That's the purchase consideration. Just like initial outlay. From the perspective of the directors of Arsenal PLC, the projection of the performance of Lacazette Limited are shown below. We have current share and the projection during the planning horizon. The assumed company tax rate is 35%. Okay, here we have tax per annum. The terminal value of the investment is treated as a constant perpetuity equal to free cash flow for the year 2016. So what the examiner is simply saying here earlier is that, of course, the base year is 2016, so we need to calculate the market value from 2017 to infinity. The risk-free rate of interest is assumed to be 6%. Here is risk-free rate, which is 6%, RF, okay, per annum. And the return on market portfolio is taken to be 13.5%. Whilst an asset beta of 1.1 is used for the purpose of the evaluation. So we have asset beta. Annual capital expenditure from 2010 onwards is estimated at 20 million naira each indefinitely. So we have capital expenditure here too, which is 20 million. Okay, Lacazette Limited currently has an issue 400 million of debts, of 8% debts. All right. And it's intended that all available cash flow should be applied to repaying these debts. So there's information on debts here. At the earliest opportunity required, advise the director of Arsenal PLC whether to proceed with this acquisition. So that is the question. That is the question. The examiner is asking you to advise the director of Arsenal PLC whether to proceed with the acquisition. So the director of Arsenal PLC will only proceed with the acquisition if and only if it will create additional value for the company. Other than that, they will not go ahead with the acquisition. Therefore, what are you supposed to do to determine the post-acquisition market value? So in this case, the first thing you need to do is to calculate your free cash flow. After calculating the free cash flow, you need to discount it at the appropriate cost of capital. Therefore, when you're about to discount it, this is where you need to ask yourself the kind of scenario involved in the question. Or you can even determine the scenario ab initio before calculating the free cash flow. So you need to ask yourself, what kind of scenario is this one? Is this scenario 1, scenario 2, or scenario 3? We said in scenario 1, business and financial risks will change as a result of the business combination. In scenario 2, only financial risks will change, the business risks will not change. As a result of that, you need to discount your free cash flow using, you need to doing the evaluation using the adjusted present value method. Then scenario number 3 is a situation whereby business and financial risks will remain constant. Both of them will not change. As a result of that, your free cash flow should be discounted using the combined weighted average cost of capital or weighted average cost of capital of the combined businesses. So that is that. So in this question, let us ascertain whether business risk will change and also financial risk will change. So, and I explained to you that if you are told in the question that both the two companies are in the same industry, provided the two companies are in the same industry, it means that business risks will not change. But if they are in different industry, then that means the business risk will change. So that is very clear. If in the question you are told that the two companies are in the same industry, it means that business risks will not change. But if you are told the two companies are not in the same industry, that means business risk will change. Another way you can determine your business risk is using asset beta. Remember, when we did project-specific cost of capital, we said that asset beta is asset beta measures business risk, and business risk is the risk associated with the industry where a company operates. So if you are given asset beta and the two companies have the same asset beta, it means that business risk will not change. So when you look at this question, in the first paragraph, you are told that the directors of Arsenal PLC are considering the acquisition of Lacassette Limited, an unquoted company. The shareholders of Lacassette are willing to sell the business on 4th January 2011 for that amount. However, when you look at this first paragraph, there is no indication that the two companies are in the same industry. So we don't have that information in the first paragraph. But however, when you look at the second paragraph, where you are given debt beta, sorry, where you are given asset beta, so you are told that the risk-free rate of interest is assumed to be 6% per annum. The return on market portfolio is taken to be 13.5%, whilst an asset beta of 1.1 is used for the purpose of the evaluation. So examiner has given you an asset beta of 1.1. So if you are given an asset beta of 1.1, it means that the two of them, since that is the only asset beta you have in the question, it means that both companies are in the same industry. So if they're in the same industry, business rates will not change. So in this question, we have identified that both Lacassette and Arsenal PLC are in the same industry as a result of the asset beta of 1.1. Then I need to go back to the question and identify if financial risk will change. Financial risk will change if the acquiring company is going to pay debts as a result of the business combination, or if you are told that after the business combination, the debt equity proportion will change. So once you are given those two information, it means that financial risk will change. I will take it again. If you are told in the question that as a result of the business combination, there will be need to pay debts, or there will be need for the debt structure of the acquiring company will increase. So as a result of that, then financial risk will change. But if you are told in the question that, also if you are told in the question that the debt equity proportion after the business combination will change, then it means that financial risk will change. Okay, but when you look at this question, in the last paragraph, examiner has told you that Lacassette Limited currently has on issue 400 million naira of 8% debt, and it is intended that all available cash flow should be applied to repay this debt at the earliest opportunity. So Arsenal PLC will pay debt of 400 million naira at 8% interest. So because Arsenal PLC will be paying 400 million naira at the earliest opportunity available, then it means that financial risk will change. So financial risk will change. Business risk is not changing because asset beta of 1.1 is given for the two companies. But financial risk is changing because of the fact that Arsenal PLC will pay a debt of 400 million naira. So as a result, you are supposed to calculate APV to value this acquisition. So if that is the case, so for us to be able to use APV, what are you supposed to do? The first thing first you need to do is to calculate the base case NPV. You know, there are 4 stages when you want to calculate adjusted present value. The first stage is to calculate a base case NPV. The second stage is to calculate the present value of financing effect cash flow. Then step 3 is to calculate APV. Step 4 is for you to advise. So in this case, I need to calculate the base case NPV. For me to be able to calculate my base case NPV, I need to calculate free cash flow. Well, okay, I need to calculate free cash flow to the firm. Once I get my free cash flow to the firm, then I need to calculate cost of equity on gear. Once I have my cost of equity on gear, then I need to multiply with the basis. I need to get my discount factor. So once I have that discount factor, I will multiply with the free cash flow. So that will give me the present value of year 1 to 2011 to 2016, that's about 6 years. So of year 1 to 6, then I need to calculate present value from year 7 to infinity. So I will then add up all the present value together to get my total present value. Once I have my total present value, I will less the purchase consideration. So once I have my once I less the purchase consideration, then I will have my base case NPV. I will keep it on one side. Then I need to go ahead and calculate. Then to the question, am I given issue cost? In this particular question, there is no issue cost. Am I given subsidized loan? In this question, we don't have subsidized loan. Am I given interest? Yes, in this question, we are given interest. Okay, that means I need to calculate present value of tax saved on interest. So once I have the present value of tax saved on interest, I need to add it to the present value. I need to add it to the base case NPV, and that will give me my APV. That's all. Once I have my APV, that will be the corporate value. So corporate value minus debt value will give me equity value. If the acquisition will create additional equity value, then I will advise the director of Arsenal PLC that they should go ahead with the acquisition. So let me stop sharing this so that I can move to the working notes. Okay. This is solution to illustration number 4. Solution to illustration 4. So Arsenal PLC. Okay. Now, we have identified from the question that this question, business risk will not change because the same asset beta of 1.1 is given for both Arsenal and Lacazette. Then financial risk will change as a result of Arsenal PLC paying debt of 400 million naira. So as a result, we are supposed to use APV. Using APV, I need to calculate base case NPV first. So I would then say calculating base case net present value. There are 6 years. In this question from 2011, you can see you are given current year value 2010. You don't need current year because your cash flow must relate to the future. So your future cash flows are from 2011 up to 2016. We are less concerned with 2010. So that's for that. So I will then go to the question. I want to calculate free cash flow to the firm. How am I going to do that? In this question, we are given profit before interest and tax. If you are given profit after tax, start from profit after tax. But if you don't have profit after tax, like in this question, then you can start from profit before interest and tax. Therefore, year 1 to 6, year 1, year 2, 3, 4, 5, and then year 6. Okay, so our figures, according to the question, figures are in million. Here is a million. So I'm starting from profit before interest and tax because I don't have profit after tax in the question. If you are given profit after tax is faster. But since I'm not given, so I will start from profit before interest and tax. So as a result, in first year, 2011, profit after tax is 96.7. So I will round it up to 97. The second year is 119. 119. The third year is 143. 143. 170. Year 5. 200. 200. Okay, so this represents the profit before interest and tax. Remember, when you are calculating free cash flow, to the firm, starting from profit before interest and tax. The next thing you need to do is to pay tax, because you are not going to consider interest expense, because the free cash flow to the firm that you want to calculate is meant for both equity holders and debt holders. So anything that has to do with debt holders or equity holders, you ignore it. So the next thing I need to do now is to pay tax. I would then say tax, which is profit before interest and tax multiplied by the tax rate. According to the question, what's the tax rate? We are given tax rate of 35% per annum. So here are 35% per annum. Therefore, bring out your calculator. 97 multiplied by 0.35 equal, 0.35 multiplied by 97 equal, that's 34, rounding, minus, next one, 119 multiplied by 0.35 equal, 42, rounding, next one, 143 multiplied by 0.35 equal, 50, rounding, next one, 170 multiplied by 0.35 equal 60. Then 200 multiplied by 0.35, 70. Here is 70, here is 70. So after tax, you need to consider non-cash item, which is depreciation. According to the question, we are given depreciation and amortization, okay? So depreciation and amortization, you had it back because it's a non-cash item. Before they arrive at the profit before interest and tax, they've already charged depreciation. And depreciation is not a cash item, therefore you need to add it back. So the first year depreciation is 42, 44, 46. Here is 42, 44, 46, 48, 50, 52. Let me confirm. Yes, correct. So that's for that. Then after depreciation, you need to consider changes in working capital. According to the question, we don't have working capital. Therefore, you ignore. The next item will be capital expenditure. So I will go back to the question, am I given capital expenditure? Yes. Examiner has told us that annual capital expenditure from 2010 onwards is estimated at 20 million naira each indefinitely. So we have capital expenditure. Capital expenditure of 20 million is a cash outflow. It's constant. 20 million constant. 20 million constant. So at this point, I need to determine the free cash flow. This is free cash flow to the firm. So I will then bring out my calculator. You can see I did not include year one because I want to calculate market value. So I don't need to, sorry, I did not include year zero. There's no point for me to include year zero when I'm calculating market value or present value. Therefore, I will say 97 minus 34 plus 42 minus 20 equal 85. Okay. Next item, 119 minus 42 plus 24 equal 101. Please, you can also confirm the numbers at your own hand so that we're sure that we are using accurate numbers. 143 minus 50 plus 26 equal 119. Next, 170 minus 60 plus 28, 138. Next, 200 minus 70 plus 30, 160. Okay. Then here is 162. So this represents the free cash flow to the firm. So at this point, I need to discount this free cash flow at cost of equity ungeared. So cost of equity ungeared at, I don't know. I need to go and calculate the cost of equity ungeared. Remember, when you want to calculate cost of equity ungeared, I gave you 3 different ways of doing that. One, if you are given beta of the proxy, then you are going to carry out 3 procedures. Identify the beta, ungear the beta, then you calculate your cost of equity ungear, which is your capping. If you are given cost of equity of the proxy, what do? You are going to use Miller-Modigliani formula to calculate your cost of equity of a gear, of ungear. Then step 3, if you are given work of the proxy, then you need to calculate work of ungear. The work of ungear is the same thing as cost of equity ungear. So in this question, we have been given a beta of 1.1. So that beta is asset beta. Asset beta is an ungear beta. So if asset beta is an ungear beta, then you are going to skip step 2, which is to ungear. You don't need to ungear anything again. So quickly, let's go and do that. Okay. Let me go to this 3rd page. So calculating, this may be too much. Let me just use, yeah. So calculating cost of equity ungeared. So because in the question we are given beta, we are given asset beta. So asset beta of, let me just make life easy a little bit, since asset beta of 1.1 is given, then capping will be calculated as the cost of equity ungeared. So in this case, we are given asset beta already, so I will just need to calculate cost of equity ungeared. So cost of equity ungeared will be equal to risk-free rate of return plus beta into market return minus risk-free rate of return. So according to the question, the risk-free rate of return, we are told to assume is 6%. Market return is given as 13.5. So here is 6% plus beta of 1.1, market return of 20.5 minus 6. Therefore, what do you have here? 13.5 minus 6 equal, multiplied by 1.1 equal, plus 6 equal 14.25. So that's the cost of equity ungeared, 14.25. You can see we have skipped step 2. We did not ungear because asset beta is already ungeared. Asset beta is the same thing as ungear beta. So that means we are going to skip step 2. We move to step 3. Step 3 says calculate cost of equity. So cost of equity ungeared is the same thing as capital Z pricing model, capping. And that's what we just did. So now that we have the cost of equity ungeared, then we need to go ahead and discount the free cash flow. Here is 14.25%. Therefore, for year 1, 14.25% raised to power 1 minus equal 0.875. Here is 0.875. For year 2, 1.1425 raised to power 2 minus equal 0.766. Year 3, 1.1425 raised to power 3 minus equal 0.671. Year 4, raised to power 4 minus equal 0.587. Year 5, 1.1425 raised to power 5 minus 0.514. And then year 6, 1.1425 raised to power 6 minus equal 0.44, just for 0.45. So at this point, I need to find the present value. So this should be the present value. So 85 multiplied by 0.875 equal, that's 74 rounding. Next one, 101 multiplied by 0.766 equal 77 rounding. Year 3, 119 multiplied by 0.671 equal 80 rounding. 138 multiplied by 0.587 equal 81. Next, 160 multiplied by 0.514 equal 82. The last one, 162 multiplied by 0.45 equal 73. So I need to calculate present value from year 1 to year 6. Okay, I'll just add up all the present value. Therefore, 74 plus 77 plus 161 plus 82 plus 73 equal 467 million. So the present value from year 1 to 6 is 467 million naira. Therefore, we need to calculate whether you are asked or not. Under valuation, once you have determined the present value from the initial stage, from the initial period, you also need to calculate present value to infinity. Whether examiner asks you or not, you must do that. All right. Therefore, I would then say present value. The base year is year 6. So I need to calculate present value from year 7. After year 6 is year 7. So I need present value of year 7 to infinity. So how do I get this? I'm going to pick the free cash flow to the firm of the base year. If there's growth in the question, if I'm given growth rate in the question, then I will say multiply by 1 plus growth rate, divide by the R minus G. But in this question, I'm not given growth rates. Therefore, I would then say divide by R. R is you can say R or cost of equity. So you can say cost of equity on gear or R is the same thing. Then multiply by discount factor of the base year. So equal. The free cash flow of the base year is year 6. The year before year 7 is year 6. So we are picking the free cash flow of the base year, which is 162. 162 million. So there is no growth. So just ignore. Divide by cost of equity on gear of 0.1425 multiplied by discount factor of the base year. Discount factor of year 6 is 4.5 multiplied by 0.4450. Therefore, what do you have as the present value of that? So I would then say 162 multiplied by or divided by 0.1425 equal multiplied by 0.45 equal. Here is 512. Here is 512. So you add it up. 512 plus 467 equal 979. 979. This represents the total present value. Total present value. That is market value. Therefore, I need to calculate my base case NPV. In this case, base case NPV to be equal to total present value. Remember, we have done this already. I've already explained this last time, using when I was during the public holiday, when I explained all the procedures. So total present value minus purchase consideration. So in this case, 979 minus, according to the question, we are told that the shareholders of Lakaseti Limited are willing to sell the business on 1st January 2011 for 500 million naira. That 500 million naira represents the purchase consideration. Therefore, the base case NPV will be equal to 479 million naira. So now that I have the base case NPV, I need to go ahead and determine the present value of financing effects. So PV, number 2, calculating PV of financing effects. So since in this question, we don't have issue costs and there is no subsidized loan, but we are given interest. So whatever we have as the present value of tax saved in interest will represent the present value of financing effects. So in this case, and our interest, the interest given to us in the question are different year on year. Therefore, we need to first see first, we are going to use table to do that. So create a column for year, interest, expense, tax saved at 30%, 35%. Then discount factor at, remember, when you are calculating present value of financing effects, you are at liberty to assume a discount rate to be used for the financing effect cash flow. You can either use cost of borrowing or you use interest rates, or you use risk-free rates. And I told you, always assume the higher one, which is at all time, the cost of borrowing will always be higher than the risk-free rate of return. Therefore, according to this question, we are given debt of 400 million naira, issue debt of 400 million naira at 8% interest. So we are going to use cost of borrowing of 8%. So we discount the tax saved at using 8%. Then we are going to have the present value. Okay? So figures in million. So year 1, 2, 3, 4, 5. There is no interest expense in year 6, so you ignore. So the interest charges for year 1 is 32. Here is 32. The second one is 27, 20. 27, 20. The next one is 12, then 1.3. 12, 1.3. Therefore, to get tax saved, Tax saved is usually company tax rate multiplied by the amount of interest. Therefore, I would then say 32 multiplied by 0.35 equal 11, rounding. Next one, 27 multiplied by 0.35 equal 9, rounding. Next one, 20 multiplied by 0.35, 7. 12 multiplied by 0.35 equal 4. The last one, 1.3 multiplied by 0.35 equal 0.46. That's 0.5. Here is 0.5. Therefore, I need to get the discount factor at 8% for year one. 1.08 raised to power 1 minus equal 0.926. 926. Year two, okay, 1.08 raised to power 2 minus equal 0.857. Year three, raised to power 3 minus 794. Year four, raised to power 4 minus 735. Year five, raised to power 5 minus equal 0.681. So to get the present value, I need to multiply the tax saved with the discount factor. So 11 multiplied by 0.9926 equal 10, rounding. Next, 9 multiplied by 0.857 equal 8, rounding. 7 multiplied by 0.794 equal 6, rounding. 4 multiplied by 0.735 equal 3, rounding. Then the last one, 0.5 multiplied by 0.681 equal 0.3. So I need to add up all the present value together. Total PV. So 18, 24, 27.3. Therefore, the PV of financing effect is 27.3 million. So step 3 now is for me to get my APV. Calculating adjusted present value, which is the same thing as corporate value. That is the total value of the entire organization. So, as you know, APV is equal to base case NPV plus minus PV of financing effect. Okay? Equal. Okay, because of space, I've done working down there. So equal. My base case NPV will go 479, I think. Yes, 479. So here is 479 plus 27. Present value of financing effect is 27. Therefore, what's the APV? APV is equal to 479 plus 27. 506 million. 506 million naira, that's the corporate value. So out of this 506 million naira, you are supposed to pay a debt. According to the question, the examiner told us that Lakaseti Limited currently has on issue 400 million naira of 8% debt, and it is intended that all available cash flows should be applied to repaying this debt at the earliest opportunity. Therefore, let's pay debt of 400 million naira, and the balance will be due to equity. There's no space. Okay, let me just manage it. Let me go to the next page. No worries. This is just the working for cost of equity on here. So we have gotten the corporate value to be 506 million. So we need to calculate equity value. So calculating equity value, because this equity value is what the shareholders and the directors of Arsenal PLC will be interested in. So to do this, I need to pick the corporate value, APV. The corporate value is 506 million. So we are paying debt value. We are paying debts. Debt value of 400 million. The balance of 106 represent the equity value. Therefore, examiner is asking us to advise the director of Arsenal PLC whether to proceed with the acquisition. I would then say the director of Arsenal PLC should proceed with the acquisition. With the acquisition of Lakaseti Limited, since it will create additional equity value of 106 million naira. That's it. This is what the examiner wants you to do. That's it. Let me know if you have any question for me so that we can move to the next illustration. So far, any question for me?
Yes, sir.
Talk to me.
So I just want clarification on something. You know, the last time when you taught us this APV, you said something about when the project is to be financed by both equity and debt, because the example we solved in class was just for debt, when the project is being financed by only debt. So when it's being financed by equity and debt, does it have effect on the cost of finance?
I explained, and I also gave you assignment on that involve both equity and debt, and I also provided the solution to that question. Even though it's not related to business valuation we are solving, but I will answer your question. The issue is that the method of financing under APV generally has to do with the PV of issue cost. Remember, I explained to you that issue costs are costs associated with underwriting and raising debt and equity capital. When you want to raise equity capital or debt capital, there are some incidental costs a company will incur as a result of that. For example, the market expenses, registration fee, okay, investment banking fee, the legal fee, and all of that. Those are incidental costs. All those costs will be incurred before the company will even receive the funds. And we now said that if in a question you are given both equity and debt, certainly if you are given both equity and debt, examiner will give you issue cost rates on each of them separately. Issue cost on equity, issue cost on debt. All you need to do is to gross it up to get the gross finance required. Once you have the gross finance required, then you need to calculate the present value of issue cost in year zero for both equity. Okay, that is the entire amount, the amount you have, your issue cost amount in year zero for equity plus the issue cost amount you have in year zero for debt will make up your total PV of issue cost in year zero. Then I now said that there is no I now said that the issue cost amount may attract tax relief in year one for only debt, because debt has tax deductibility benefits, just like your borrowing cost. So therefore, when you want to calculate the present value of issue cost, you are supposed to include the tax saved on issue costs on debts in year one only. You don't include tax saved on equity. It is only on issue cost on debts. So you don't include on equity, and that's what I explained to you. Is it clear now?
Yes, sir, it is. Thank you, sir.
You are welcome. So let's have one more illustration. Now, we have solved illustration for scenario 1, scenario 2, then let's go to scenario 3. Let me look for a question that has to do with scenario 3. Yes. Let's go to illustration number 6. Illustration number 6. I need somebody to read for me, please. Illustration number 6. And we need to be as fast as possible so that we don't extend beyond the normal time. So who will help us to read? Who will help us?
Illustration 6.
Okay, thank you.
Anto PLC will soon announce a takeover bid for Julian PLC, a company in the same industry. The initial bid will be an all-share bid of 4 Panto shares for every 5 Julian PLC shares. The most recent annual data relating to the two companies are shown below. The takeover is expected to result in cost saving in advertisement and distribution, reducing the operating cost, including depreciation of Panto from 76% of sales to 70% of sales. The growth rate of the combined company is expected to be 6% per year for 4 years and 5% per year thereafter. RTS debt obligation will be taken over by Panto. The corporate tax rate is expected to remain at 30%. Sales and costs relevant to the decision may be assumed to be in cash terms. Required. Estimate how much synergy is expected to be created from the takeover using free cash flow to the firm analysis for each individual company and the potential combined company. State clearly any assumptions that you make. Note, the weighted average cost of capital of the combined company is assumed to be 9%. B, discuss any 5 limitations of the above estimates. Explain generally 3 advantages and 2 disadvantages of expansion through merger and acquisition rather than through organic growth.
Thank you, Prosper. So in this question, examiner wants you to calculate how much synergy is expected to be created from the takeover using the free cash flow to the firm analysis for each individual company and the potential combined company, which means that we are going to calculate present value, market value for Panto, keep it on one side, present value of Julian, keep it on one side. Then you now add the two of them together. That will represent the pre-acquisition market value. Then you also need to calculate market value after the business combination. So that means three different tables, three different cash flows, three different market values are what you are going to calculate based on the requirements. So it's a very big one, even though it's very straightforward, but it takes time. And you have to be very careful with this kind of a question. Make sure you articulate how you are going to present your work before you jump into solving the question. However, now I want to calculate, the examiner is asking me to determine how much synergy, okay, is expected to be created. The synergy to be created from this business acquisition will represent the difference between the post-acquisition market value and the pre-acquisition market value of the combined businesses. So what am I supposed to do? I've already explained it. I'm going to calculate market value for Panto. I will calculate market value for Julian. I will add the two together. That will give me the pre-acquisition market value. Then I will now combine the resources of the two companies together to get the post-acquisition market value. Once I have the post-acquisition market value, I will less the pre-acquisition market value. The difference will be the synergy that is to be created. So that will solve the question. However, in determining market value for each of the company, I need to determine from this question, or for the combined company, I need to determine from this question, what kind of scenario is this one? Is this scenario 1, scenario 2, scenario 3? We are looking for scenario 3, whereby business and financial risks are expected to remain constant, will not change as a result of the business combination. And if that is the case, we are supposed to discount the free cash flow using the existing WACC of the combined businesses. So if that is the case, let's go and identify first from the question whether business and financial risks will change or will remain constant. So according to the first paragraph of this question, we are told that Panto PLC will soon announce a takeover bid for Julian PLC, a company in the same industry. So because they are in the same industry, it means that business risk will remain constant, will not change. So because business risk is the risk arising, is the risk that measures the industry risk, okay? Is the risk that measures industry risk. So since the two companies are in the same industry, that means the business risk will remain constant. Then, according to the question, let's identify if financial risk will change. And we said financial risk will change if the combined business is going to pay debts as a result of the business combination, or debt equity proportion are expected to change as a result of the business combination. So when you look at the last paragraph, the only information that we have that has to do with debts is the fact that we are told that, please, this one is not RT, it is Julian. Okay, Julian is Julian's debts, okay, not RT. So Julian's debt obligation will be taken over by Panto. So that's the only information we have on debts. So we are told that Julian's debts obligation will be taken over. When you are taking over, when you acquire a company, certainly you are going to acquire both equity, both their assets and liabilities. So, but we are not told in this question that the combined business the debt equity proportion will change. We are not told that Panto will be paying debt. We are just told that it's going to take over. When you are taking over, it doesn't mean that you are paying debt. All right. So in this case, business risk is not changing, financial risk is also not changing. So as a result of that, so you are going to value the free cash flow using the current WACC of the combined businesses. So if that is the case, I need to go ahead and calculate the free cash flow for each of the companies. Once I'm done with the free cash flow, I also need to calculate WACC of each company. So WACC of Panto, I will discount free cash flow of Panto using the WACC of Panto. I will discount free cash flow of Julian using the WACC of Julian. Then I also discount the free cash flow of the combined business with the current WACC of the combined business. And the current WACC of the combined business, examiner say we should assume 9%. Examiner say we should assume 9%. So if that is the case, let's stop sharing this and move to the working notes. Okay. So solution. So illustration number 6. So like I said, we are going to do it separately. So I will then say calculating number 1, calculating pre-acquisition market takeover is the same thing as acquisition. So pre-acquisition market value of Panto as of today. How much is the worth? What's the market value of Panto before the business combination? So to do this, I will go back to the question. What's the number of years given? Examiner has mentioned 4. We are told that expected annual growth rates in sales, operating costs, including depreciation, replacements, investments, and dividend for the next 4 years. So we have been given 4 years. Therefore, I need to calculate for the next 4 years. So let me teach you a shortcut. So I can create a column here for my working. Okay. I will then do year 1, year 2, year 3, year 4. Let me expand that one a little bit more. Okay. Year 3, and year 4. So year 1, year 2, year 3, year 4. Remember, when you are calculating market value, you don't include year 0. So starting from 6, according to the question, you cannot use, in this question, examiner has given to us profit after tax. We have profit after tax for the 2 companies, 1739, then 833. That profit after tax is your after tax income. We cannot use that information because the examiner has told us that there is annual growth rates in sales, operating costs, replacement costs, and all of that. Therefore, you cannot use your profit after tax. So we need to start from the beginning. So if that is the case, I would then say sales. I will go to the question, how much is sales revenue for Panto? The sales revenue of Panto is 13,333. So I will then come here, 13,333. Examiner has told me there is an inflation. I should grow it. There's a growth rate for Panto of 5%. The growth rate of Panto is 5%. Expected annual growth rate in sales, operating costs, including depreciation, is 5% for Panto. Therefore, at 5%, therefore, this 13,333 is in current value terms because according to the question, examiner has told us that the most recent annual data relating to the 2 companies are shown below. That's current value terms. All those our discussion under capital budgeting as per inflation still applies there. So since we are given current value terms, then we should start inflating from year 1. Therefore, bring out your calculator, 13,333 multiplied by 1.05 equal, that's 14,000. Here is 14,000. What you have in the calculator, not what you write on the screen, not 14,000, but what you have in your calculator, multiplied by 1.05 equal, that's 16,700, 14,700. The next one, what you have in your calculator multiplied by 1.05 equal 15,435. Number 4, multiplied by 1.05 equal 16,206. So with this, I've grown the sales revenue. After sales revenue, the next item is operating cost. Operating costs. And the examiner has told us that operating costs included depreciation, which is normal thing, because in your POL, in your profit or loss accounts, after sales value, you less direct costs, you have your gross profits. From your gross profits, you less your operating costs, which is the same thing as your OPEX, operating expenses. Included in your operating expenses is depreciation. Therefore, it is normal for you to include depreciation in your operating costs. So I will then go to the question for Julian. Sorry, for Panto. How much is operating cost? Operating cost is 8683. Then I will have depreciation of 1450. So operating cost is equal to 8683, then plus 1450 at 5%. Okay, 086, yes, 8683. All right then. So I would then say 8683 plus 1450 equal 10,133. Then multiply by 1.05 equal 10,640. 10,640, you had it back. What you have in your calculator multiplied by 1.05 equal 11,172. Next, what you have in your calculator multiplied by 1.05 equal 11,730 multiplied by 1.05, 12,317. Okay, that's it. I'm done with operating costs. You have to put it in bracket because it's a cost. After operating costs, I need to determine profits. So 14,000 minus 10,640 equal 336. 3,360. I need to pay tax. This is profit. The next item will be tax. How much is the tax rate according to the question? Tax rate is 30%. So tax rate is 30%. Therefore, at 30%, so I need to pay tax on that. So I can say multiply by 0.3 equal 1,008. Then the next one, 14,700 minus 1,172 equal 3,528. Multiply by 0.3, 1058. Okay, 15,435. Multiply by, sorry, minus 11,730 equal 3,705. Multiply by 0.3 equal 1,112. 16,206 minus 12,317 equal 3,889. Multiply by 0.3, 1,167. Okay, so at this point, immediately after tax, remember you need to, we are calculating free cash flow first. So immediately after tax, you need to add back non-cash item, which is depreciation. So depreciation for Julian is 1,450. It will grow at 5%. Therefore, 1,450 multiplied by 1.05 equal 1,523. Multiplied by 1.05, 1,599. Multiplied by 1.05, 1,679. Multiplied by 1.05, 1,762. So after depreciation, you need to consider changes in working capital. We don't have working capital in the question. Therefore, we need to consider capital expenditure. And according to the question, we are told that annual replacement capital expenditure is 1,600 for Panto. Capital expenditure equal 1,600, and this will grow by 5%. Therefore, 1,600 multiplied by 1.05 equal 1,680. It's a cash outflow. 1,680 multiplied by 1.05 equal 1,764. Multiplied by 1.05 equal 1,852. Multiplied by 1.05 equal 1945. Okay, so this represents capital expenditure. So at this point, I need to determine my free cash flow to the firm. Here will be free cash flow to the firm. So 3,360 minus 1,008 plus 1,523 minus 1,680 equal 2,195. Next one, 3,528 minus 1,058 plus 1,599 minus 1,764 equal 2,305. Next one, 3,705 minus 1,112 plus 1,679 minus 1,852 equal 2,420. The last one, 3,889 minus 1,167 plus 1,762 minus 1,945 equal 2,539. So now that we have the free cash flow to the firm, we need to discount it at the appropriate cost of capital, which is the current WACC of Panto. So let's go and do working for cost of capital. So this is for Panto. This is for Julian. Then this is for the combined. Then let's do our working here for that. Working number 1. Calculating WACC. Okay, we want to calculate WACC for each of the companies. So WACC is calculated as equity value over, before you calculate WACC, you need to calculate cost of equity, cost of debt, then the work itself. Therefore, let's start from cost of equity. Calculating cost of equity. So I'll need to go back to the question. How am I going to calculate my cost of equity? As you can see from the question, the examiner has given us information on capping. Because in this question, I can see risk-free rate of return of 4%. I can see market return of 11%. And we're also given equity beta of 1.8 and 1.38 for both Pancho and Julian. Since we have information on beta, on the capping, then we are going to calculate cost of equity using capping. Therefore, I would then say cost of equity equal to risk-free rate of return plus beta into market return minus risk-free rate of return. So for Panto, the risk-free rate as given to us in the question is 4%, market return is 11%. So here is 4 plus the beta of Panto. Beta of Panto is, equity beta of Panto is 1.18. Market return is 11% minus 4. So for Panto, cost of equity will be 7 multiplied by 1.18 equal, then plus 4 equal 12.26. Here is 12.26% as the cost of equity. Then for Julian, risk-free rate of return is 4. The beta of Julian is 1.38. 1.38. Market risk premium is 7. That's different between 11 and 4. So what do I have here? 7 multiplied by 1.38 equal plus 4 equal 13.66%. So I need to calculate cost of debt. Calculating cost of debt. KD. So how do I get my cost of debt? I will go to the question. How am I going to calculate my cost of debt? Examiner has told me that current market cost before tax of fixed interest debt, 6% for Pancho, 7.5% for Julian. Okay? That's the cost of debt. The cost of debt is 6% for Pancho, 7.5 for Julian. So I will then say KD. I need to calculate after-tax cost of debt. So after-tax or post-tax cost of debt. So KD will then be equal to interest into 1 minus tax rates. So for Panto, the interest rates from Panto is 6%. So here will be 6 multiplied by a tax rate of 30%. So we have to account for 70%. So multiply by 0.07. So here will be equal to 6 multiplied by 0.7. That's 4.2%. Then for Julian, after tax cost of debt of Julian is 7.5. Sorry, before tax is 7.5 multiplied by 70% tax rates, 1 minus tax. So this will be 7.5 multiplied by 0.7 equal 5.25. So I need to calculate WACC now. Calculating weighted average cost of capital, denoted as KW. So WACC equal to equity value over equity plus debt, cost of equity plus debt value over equity plus debt, cost of debt, 1 minus tax. 1 minus tax multiplied by 100%. Therefore, for Panto, equity value of Panto, let's go back to the question. What's the debt equity proportion of Panto? We are told that gearing, long-term debt divided by long-term debt plus equity by market value, 30%. So if debt is 30%, it means equity is 70% for Panto. Again, Julian is 55% debt. That means equity will be 45%. That means Julian is highly geared. So in this case, since debt is 30%, equity will be 70%. Therefore, I will just say 0.7 multiplied by cost of equity of 12.26. Okay. Plus debt is 30% multiplied by cost of debt for Pancho is 4.2% after tax. So there's no need for you to come and put 1 minus T again because we've already adjusted for tax using this. Therefore, for Pancho, I can then say 0.7 multiplied by 12.26 equal, that's 8.58. 8.58% plus 0.3 multiplied by 4.2 equal 5.29. So when you add it up, 8.58 plus 5.29 equal. No, something is wrong. This cannot be 5.29. 0.3 multiplied by 4.2, 1.26 rather. It's supposed to be 1.26%. Okay, 1.26. Okay then. So let me now add plus 8.58 equal 9.84%. 9.84% approximately. This is 10%. So the WACC of Pancho is 10%. Let's calculate for Julian. For Julian, the debt equity proportion of Julian is 55%. So if debt is 55, equity will be 45. So 0.45 multiplied by cost of equity of Julian is 13.66. Plus debt value is 0.55, 55%, multiplied by after tax cost of debt of Julian, 5.25. Therefore, 0.45 multiplied by 13.66 equal 6.15 plus the other side, 0.55 multiplied by 5.25 equal 2.89. when you add it up. 6.15 plus 2.89 equal 9.04%. So approximately here is 9%. So that's 9%. So let's quickly do it once and for all. For the combined, examiner has given to us for the combined to be 9%. So we don't need that for now. So the next thing we need to do now, is to calculate the value of Panto. Excuse me. Panto. Okay. Now let's go back there. The cost of capital, the work of capital of Panto, the work of Panto is 10%. So let's go and discount the free cash flow to the firm of Panto. So I would then say at 10% for year one, 0.909826751,683. So let's get the present value. This is what we are looking for, PV. You can see SFM is very interesting. So 2195, that's if you know what you are doing, multiply by 0.909. That's 1995. Here is 1995. 2305 multiplied by 0.826 equal 1904. Next one, 2420 multiplied by 0.751 equal 1817. 2539 multiplied by 0.683 equal 1734. Therefore, I need to calculate present value of year 1 to 4. So this will give me, I need to add up all the present value. So 1995 plus 1904 plus 1817 plus 1734 equal 7450. Here is 7450. So for Pancho, I need to calculate PV of year 5 to infinity, which is equal to, because in this question we are given growth rates. Therefore, I would then say free cash flow to the firm of the base year multiplied by 1 plus the growth rate divided by cost of capital, which is WACC, minus the growth rate multiplied by discount factor of the base year. So figures are in thousands. Are they in thousands or in million? They're in thousands. Figures in thousands. Okay. So equal. What's the free cash flow of the base year? Base year is year 4. So free cash flow of year 4 is 2539. 2539. What's the growth rate after year 4? Let's go back to the question. Examiner has told you that the cash flow will grow by 4% after 4 years. 4% after 4 years for Panto. So that will be 1.04 divided by cost of capital of Panto is 10%, 0.10 minus the growth rate of 0.04 multiplied by the discount factor of the base year. The discount factor of the base year is 0.683. 0.683. So what you get equal 2539 multiplied by 1.04 equal divided by 0.06 equal multiplied by 0.683 equal. That's 30,058. Here is 30,058. When you add it up to that one, okay, plus 7,450 equal 37,508. 508. So this represents the total present value of Panto. This is total present value of Panto. So we need to calculate total present value of Julian. So number 2, calculating pre-acquisition market value of Julian. The same thing as I did for Panto. Okay. How many lines did I create for this one? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So 10 lines. 1, 2, 3, 4, 5, 6, 7, 8, 9, then 10. Okay. Right. Okay. Year 2, year 3, and then year 4. All right, then 1, 2, 3, then 4. So 6. I will go to the question, how much is the 6 for Julian? The 6 for Julian is 94. Here is 9,400. What's the inflation rate for the first 4 years for Julian? 6.5%. So at 6.5%, quickly, 1.065 multiplied by 94 equal 10,011 multiplied by 1.065 equal 10,662 multiplied by 1.065 11,355. Okay, multiplied by 1.065 equal 12,093. So that's for that. And we have operating costs. So operating costs included depreciation. So operating cost for Julian is 5,450 plus depreciation of 1,100. So A is 5,450 plus 1,100 at 6.5%. 5,450 plus 11 equal, sorry, mistake. 5,450 plus 1,100 equal, they multiply by 1.065 equal 6,976. What you have in your calculator, multiply by 1.065, 727429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. 7429. multiply by 1.065, 7912, multiply by 1.065 equal 8426. So let's find the profits. 10,011 minus 6976 equal 3035. There is tax at 30%. So multiply by 0.3 equal 911. Next one, 10,662 minus 7429 equal 3233. So multiply by 0.3 equal 670, 970. 11,355 minus 7912. 3443. Multiply by 0.3. 1033. 12093 minus 8426 equal 3667. Multiply by 0.3. 100, 1100. So I need to add back no cash item. Depreciation is 100. So we have to grow this at 6.5%. Therefore, 1100 multiplied by 1.065 equal 1172. What you have in your calculator multiplied by 1.065. 1248. 1248 multiplied by 1.065. 1329 multiplied by 1.065. 1415. After depreciation, we consider capital expenditure since we don't have working capital. Capital expenditure for Julian, we are told is 1240. So here is 1240 at 6.5%. So what do you have? 1240 multiplied by 1.065. 1321 multiplied by 1.065 equal 1406. Multiplied by 1.065, 1498. Multiplied by 1.065, 1595. So find the difference. That will be the free cash flow to the firm. So equal 3035 minus 911 plus 1172 minus 1321 equal 1975. Okay. Then 3233 minus 970 plus 1248 minus 1406 equal 2105 5 minus 1033 plus 1329 minus 1498 equal 2243. Finally, 3687 minus 100, 1100, then plus 1415 minus 1595 equal 2387. So I need to discount this at 9%. We got cost of capital. The WACC of Julian is 10%. WACC of Julian is 10%, sorry, 9%. So let me confirm, yes, Julian WACC is 9%. So let's get discount factor at 9%. 1.09 raised to power 1 minus equal 0.917, 0.917, 1.09 raised to power 2 minus equal 0.842, 1.09 raised to power 3 minus 772. Lastly, 1.09 raised to power 4 minus equal 708. So 1975 multiplied by 0.917 equal 1808. 2105 multiplied by 0.842 equal 1772. 2243 multiplied by 0.772, 1732. 2387 multiplied by 0.708 equal 1689. That's 1690. So add it up. Therefore, present value of year 1 to 4. Let's add it up. 1808 plus 1772 plus 32 plus 90 equal 7002. So I need to calculate PV of year 5 to infinity, which is the free cash flow of the base year of 2387 multiplied by the growth rate of Julian after year 4 is 5%. So 1.05 divided by cost of capital of 9% minus growth rate of 5% multiplied by discount factor of the base year of 0.708. So final answer. So this should give me 2387 multiplied by 1.05 equal divided by 0.04 equal multiplied by 0.708 equal 44362. Here is 44632. Add it up. 362. 44362. 362. Okay. So this represents total present value, that is market value from year one to infinity. So what do I get? 7,002 plus 44,362 equal 51,364. So the next thing I need to do now is to calculating pre-acquisition market value of the combined companies. So all I need to do is to just add up together the market value of both companies before the combination. So pre-acquisition market value of Panto plus pre-acquisition market value of Julian. The market value of Julian is 51,364. Panto is 37,508. 508. Add it up. Plus 37,508 equal 888,72. So this represents the pre-acquisition market value. Total pre-acquisition market value. So now that I have the pre-acquisition market value, I need to get the post-acquisition market value of the combined. So number 4, post-acquisition market value of the combined. So the same way I calculated for market value of Panto and Julian is what I'm going to do here as well. But this one should be faster. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 maximum. Okay. That's not straight. Right. Year 1. That's too big. Year 2. Year 3. And then year 4. 1, 2, 3, 4. So 6. For me to get the 6, I'll go to the question, what is the sales value of Panto plus the sales value of Julian? So I will add it together, 13,333 plus 9,400. What's the inflation rate? What's the growth rate after the combined? When you go to the last paragraph, the paragraph before the paragraph after the table, you are told that the takeover is expected to result in cost saving in advertising and distribution, reducing the operating cost, including the depreciation of Panto from 76 of sales to 70% of sales. The growth rate of the combined company is expected to be 6% per year for 4 years and 5% thereafter. So 6% is the growth rate. So multiply by at 6%. So let's add 13 plus 9,400 equal, multiply by 1.06 equal 24,097. Here is 24,097. what you have in your calculator multiplied by 1.06 equal 25,543. 25,543. Next one, multiply by 1.06, 27,075. 27,075 multiply by 1.06, 28,700. Next one is operating expenses. Examiner has told us that operating expenses should be 70% of the sales value. Okay? Operating cost. Which is 70% of sales. Therefore, I would then say 24097 multiplied by 0.7 equal 16, 868. Next, 25,543 multiplied by 0.7 equal 17,880. Next one, 27075. That's an error on my calculator. 27075 multiplied by 0.7 equal 18,953. The last one, 28,700 multiplied by 0.7. What's wrong with you? 28,700 multiplied by 0.7 equal 20,090. So find the difference. 24097 minus 16, 868. 868 equal 7229. We have tax at 30%. So multiply by 0.3, 2169. Next one, 25543 minus 17,880 equal 7663 multiplied by 0.3 equal 2299. Next one, 27075 minus 18,953 equal 8122 multiplied by 0.3, 2437. Okay, 28,700 minus 2090 equal 8610 multiplied by 0.3, 2583. Okay, then you need to add back depreciation. Depreciation for Panto is 1450. Depreciation for Julian is 1100. So at a growth rate of 6%. Therefore, 1450 plus 1100, 255 multiplied by 1.06, 2703 multiplied by 1.06, 2865 multiplied by 1.06, 3037 multiplied by 1.06, 3219. Then capital expenditure. The capital expenditure for Julian for Panto is 1600 plus 1240 for Julian at 6% growth rates. So 1600 plus 1240 equal multiplied by 1.06 equal 3010. Multiplied by 1.06, 3191. Multiplied by 1.06, 3382. Multiplied by 1.06, 3585. So let's get the profits. Sorry, free cash flow to the firm after the combination. So 7229 minus 2169 plus 2703. Okay, 2703 minus 3010 equal. Here is 4753. So discount factor at 9%. Examiner say we should, after the business combination, we have to use 9% as our discount factor. So if that is the case, we have done it before for Julian. The discount factor of Julian is 0.917. Here is 0.917. Year 2, 0.842. 0.842. Year 3, 772. 0.772. 0.708. So what I have in my calculator multiplied by 0.917 equal 4359. Here is 4359 as the PV. Then year 2, 7663 minus 2299 plus 2865 minus 3191 equal 5038 multiplied by 0.842 equal 4242. Next one, 8122 minus 2437 plus 3037 minus 3382 equal 5340 multiplied by 0.772 equal 4122. Next, 8160 minus 2583 plus 3219 minus 3585 equal 5211 multiplied by 0.708 3689. So add it up. PV year 1 to 4 would then be equal to 4359 plus 4242 plus 4122 plus 3689 equal 16412. Okay, then I need to add PV of year 5 to infinity, which is the free cash flow of the base year of 5211. Growth rates after year 4 for the combined, we are told is 5%. Okay, 5% per year thereafter. Therefore, 1.05 divided by cost of capital of 9% minus growth rate of 5% multiplied by discount factor of base year of 0.0708. So what you get? Calculator. 5211 multiplied by 1.05 equal divide by 0.04 equal multiply by 0.708 equal, that's 96. 96. Something is not right here. Let me confirm again. This is 16. Okay. Let me do it again. 5211. This 5211. Let me confirm it. 8160 minus 2583 plus 3219 minus 3585 52. Okay. Multiply by 0.708 equal 3689. Okay. That's it. It's what it is. Therefore, 5211 multiplied by 1.05. 1.05 equal divided by 0.04 equal multiplied by 0.708 equal, that's 96. 96,846. 846. So add it up. 16,412 plus 96,846. 113. 113. 258. 258. Prosper, Blessing, Debbie,
Yeah.
Flood, are you
Yes, sir.
confirming the accuracy of these numbers?
Yes, sir.
Because something this year, this second one is somehow strange to me. That number is not familiar. I'm not sure if that number is correct.
So which number? The 96846.
Yes, it's correct. Based on what I've done about, I think, I don't know.
From the table.
Yeah, some of the numbers on the table I think is wrong because I solved this particular question recently. This one's supposed to be 105, where I get 96,846 supposed to be 105. So possibly some of this calculation is not right. Please confirm the accuracy quickly. Just check. Let's do it. Let's confirm the numbers.
They are the same on my end.
They are the same. Okay,
Yes, they are the same on my end.
it's all right. So in case when you're on your own. Now, if that is the case, the total present value, the post acquisition market value is that. So examiner is now asking you, examiner is asking you to estimate how much synergy is expected to be created. So in this case, I would then say synergy. Let me go to the next one. That would be number 4. Number 5. Synergy.
Excuse me, sir.
Yeah.
I think the issue came from the profits under 4. You
Yeah,
have,
4.
yes, the profit. You have
Oh,
8160.
81.
Supposed to be it's supposed to be 8610.
Let me do it again.
The profit.
28,700 minus 2090. Oh, 8610. Correct. That's an error. Thank you. So 8610. 8610. Then multiply by 0.3 equal 2583. It's 2583 now. Okay.
So the problem is not from the it was actually 8610 we have there before.
But no,
But
I
the
wrote,
calculation,
yeah, go ahead.
okay, the calculation is giving me 14271 and not 5211. That's
52,
under the free cash flow to the firm.
okay. Okay, let me quickly check that again. I'm coming. Um, 8610 minus 2583 plus 3219 minus
Okay, this profit
3585
mistake.
equal is 5661. This is supposed to be 5661, not 5211. That's where the mistake is coming from. 5661. So multiply by 0.708 equal 4008. Here's supposed to be 4008. So I will then add up. So plus 4122 plus 4242 plus 4359 equal 16731. This one is 16731. Okay. So here is supposed to be 652. So 5661. Therefore, 5661 multiplied by 1.05 equal divide by 0.05 equal multiply by 0.708 equal. What am I doing? Error. 5661 multiplied by 1.05 equal, divide by 0.04 equal, multiply by 0.708 equal 105,210. That's it. 105,210. Then plus 16,731 plus 16,731 equal 121,941. 121,941. Thank you for the observation. Let's move on. Let's put it, we're almost there now. So synergy, examiner is asking you to estimate how much synergy is expected to be created. So I would then say synergy, the expected synergy to be created represents the difference between the post acquisition market value and the pre-acquisition market value of the combined companies. This is shown as follows. So I would then say synergy post acquisition market value 121 million 121 million 941 941 then minus pre-acquisition market value of 800 and something 88
7.2.
872 88 872 872. So the difference is the synergy minus 88 872. That's 33,067. Is it 67? 33,069. So that's the synergy created. So that's that. So this is where we are going to stop for the B part is just written one. I can forward it to you. So that's the end of the question. So I have one more illustration for you, one or two more illustration, but not today again. So we're going to solve this illustration. That will be our last class. This particular one and one more illustration that has to do with asset-based approach. Okay, so let me know if you have any question for me, so we can call it a day. The day is fast spent already. Talk to me. Do you have any concern in our calculation so far?
So I have a question, please.
Talk to me.
Yes, sir, during the calculation of this free cash flow for the firm, I noticed when we after sales, right, we deduct operating costs, which has a content of depreciation in it.
Yeah.
Then we also went for that to add back depreciation. So my question is, what if we did not want to go through that procedure and decide to ignore depreciation, since the one we're adding later can also cancel the one we deducted initially?
No, you cannot do that. When you talk about operating costs, at any time, operating costs supposed to include depreciation. You know, your POL, your profit or loss account, after sales, you less cost of goods, so your direct cost, you have your gross profit, isn't it? So immediately after your gross profit, you less your operating cost. Included in your operating cost administrative costs, the marketing expenses, distribution costs, depreciation, all those operating expenses are included in your, all those kind of costs that company usually spend for the day-to-day running of the business are included in your operating costs. So ordinarily, your operating cost is supposed to include depreciation. But according to this question, the examiner tell you that this operating cost, the one given to you, does not include depreciation. Therefore, include your depreciation in the operating cost. And that's why we included it in the first instance. And you know, when you are calculating free cash flow you are supposed to add back depreciation, because depreciation is a non-cash item. Say, for example, now, let's even forget about all what I've been saying. Say, for example, you are given profit before interest and tax. Do you know that before you arrive at profit before interest and tax, the company has already deducted depreciation? Do you agree,
Yes,
Prosper?
sir.
Uh-huh.
Yes, sir.
So it's the same thing here. So I didn't mean we are given profit before interest and tax. We just have from profit before interest and tax, then you add back depreciation. That's the normal thing we should do, Abby. But
Yes, sir.
in this question, the examiner did not give it to, so we are the one that is calculating the profit before interest and tax. So the profit before interest and tax is this profit now. So before we arrive at this profit, we are supposed to have charged depreciation, and that's what we have done by by adding depreciation to operating costs so that we can get the profit before interest and tax. Do you get it now?
Yes, sir. Thank you, sir.
You are welcome. Yes, any other questions before we close the day? All right, so in the absence of no additional question, please, let's call it a day. We have one more class to end this particular diet, and it's possible we may meet. I need to find out from my other colleagues if I have a free period between now and Saturday. So we may need to meet before, so that latest on Sunday. If there is no space, then on Sunday I must have you. I must have it on Sunday by the grace of God. So thank you guys for your time. I'll see you next time when we shall be rounding up for the diet. Good night.
Good night,
Thank you,
sir.
sir.
All right.